Good morning, everybody. Welcome to The Long-Term Investor. I am joined by Phil Huber, Managing Director and Head of Portfolio Solutions at Cliffwater. Phil, thank you so much for joining me here at the Morningstar Investment Conference 2024.
Thanks for inviting me to be on as your guest, Peter. I've done a lot of podcasts before. This is, I think, my first live recording in front of an audience, so it should be fun. Thanks to everybody here for joining.
Well, shout out to the Morningstar crew, because I've done a number of live podcasts and they have an incredible setup. But it's also fun because we're in the exhibit hall, so we have lots of people walking by, but we have a full house here. Maybe we just level set, Phil, and give everyone a little bit of background on how you got to where you are today in your role with Cliffwater.
Great. Yeah, so I joined Cliffwater just at the beginning of this year. And prior to joining, I spent 16 years, pretty much my entire career on the wealth management side of the business. Most recently as CIO of Savant Wealth Management. And so a little bit of a career pivot, but I had reached a point where a lot of my interest and attention was being paid towards alternative investments. And so I just thought I wanted to do something a bit more focused there. And I had worked with Cliffwater while at Savant and was very familiar with the firm's history, the fund platform, et cetera. And so we developed a cool role together. And then so far it's been going great.
Well, that's one of the things that I've always loved about your perspective on alternatives is you have the practitioner's perspective. And you wrote a wonderful book that if you all have not seen before, you should check out. It's called The Allocator's Edge. It came out in 2020.
2021.
Oh, 2021.
End of 2021, yeah.
Okay, end of 2021, but the book uses a lot of 2020 data points. And there's a number of ideas that support the use of alternative assets, but it seemed like at the time that the most prevalent was equity and bond valuation. So I'm curious, when Phil Huber writes the second edition of The Allocator's Edge, and I know that your publisher is here this week, so maybe he's licking his chops for this, but how would you approach that argument? Talk a little bit about what that argument was for alternatives based on the future expected returns of stocks and bonds.
Yeah, so I started the book. The first chapter was called Hindsight is 60/40, and it was meant to kind of set the table of like what was the history of 60/40? Why did everybody adopt that as sort of the standard traditional asset allocation construct? And why was it facing, some challenges ahead potentially? I mean, the timing couldn't have been more, I guess, lucky, for lack of a better word, and that the book came out end of 2021, and then 2022 was the worst year in our lifetimes, I guess, for 60/40 and an environment for fixed income where no one had really seen double-digit declines in bonds. Certainly not me in my career. And so it wasn't any particular market timing on my end. It was just, I think, just coincidence of when the book came out. But it was very clear then it was a very extreme valuation environment. Not so much maybe for stocks. I would argue the stock environment today is maybe sort of similar to what it was when the book came out, but very different environment for fixed income today. Yields much higher. It took a fair amount of pain to get there, but the bond piece of that 60/40 is in a much better place than it was heading into 2022.
Well, and I think even though that may not be the primary reason that somebody goes to alternatives, a couple things for people that I jotted down that came directly from the book is that you see that the majority of excess returns in both stocks and bonds came in periods where either inflation was low or inflation was falling. So today we have inflation falling, but it is a little bit elevated versus what we had the past few decades. Another thing that I think a lot of investors forget, a lot of advisors forget, we have a generation of advisors who have not gone through an extended period where the US equity premium was negative. Now, you and I came into the profession in 2007, where we were in the midst of a lost decade, but just to give some perspective, if we go back to 1927, the US equity premium, which means that basically cash beats stocks, it was 30% of the time that happened in one-year observations, 21% of five-year observations, and 15% of 10-year observations. So it has been really easy to be a US investor. I would argue it's been very easy to be a US advisor, a US-based advisor. And so while this isn't as prevalent of a narrative, it is still something I think people have to keep their eyes on in general. Now, the other narrative that today seems more prevalent would be the private versus public markets. Yeah. So we're talking about the equity risk premium, which is public market. Can you talk a little bit about that private versus public and how this fits into the decision to go towards alternatives?
I think, yeah, I mean, relative to when my career started, like private markets are humongous today. Whereas they were, if you just look at kind of like the global market portfolio, 15, 20 years ago, like private markets were sort of a rounding error. So it wasn't a decision a lot of advisors had to think of in terms of how they build a portfolio where they're thinking, okay, how much US versus international should I have? How much large versus small cap, value versus growth? I think today and going forward, you're going to start to see more advisors really think of private markets in a similar fashion, where it's an active choice. And how much should I not should I be invested in private equity or private debt, but how much, and what is that allocation decision? Having more conversations with end clients around what their illiquidity budget might be. Whereas I think historically many advisors just adopted a fully liquid 100% mutual fund kind of ETF type portfolio. And so the toolkit looks a lot different today. There's a lot more, fund structures that are becoming increasingly adopted and popular by advisors and have opened up different asset classes. So I think if you're starting with a blank slate today and building a portfolio from the ground up, it's a much different exercise, and there's more options available than there were, back when we entered the business. So.
Absolutely. And I was so excited by this giant crowd we have, every seat filled, and we have a big standing audience, that I forgot that we probably should define alternatives to some extent, because we've only really been saying privates. How would you define alternatives?
I don't think there is no universal definition for it. Part of it is because the definition it's in the eye of the beholder, and it depends on what people are familiar with or accustomed to owning. Like real estate's a good example. Some might consider that like just a classic, traditional asset class. Others, maybe not. And so to me, it's more of a catch-all for anything not stocks, bonds, or cash. That's kind of where I start. When you start looking at the various, asset classes and strategies that people kind of put under that umbrella, what I find is that in most cases, there's some sort of connection to a traditional asset class with a little bit of a twist. And what you find are kind of three variables that make something that often we think of as traditional and kind of convert it into an alternative. So one is liquidity, and the classic example there would be private equity, which is similar to public, but just doesn't it's illiquid, doesn't trade, or doesn't trade often, I should say. The other would be implementation, so things like classic investing strategies like value or quality or momentum that you often see in a long only construct, using tools like leverage or shorting or derivatives and implementing them differently in a way that kind of removes that traditional market beta exposure and leaves you with a different type of exposure. So implementation, and then the third being what I kind of think of as packaging. So I call this kind of old wine in new bottles, like things that have existed for centuries or millennia that are just now becoming more adapted because they're more readily available through things like interval funds or other fund structures. But examples being, private credit is obviously the hot topic today. Credit has been around for centuries in different formats. Reinsurance is another one it's a centuries old, business model. We just now have the ability to access it as a risk premium inside of a diversified portfolio. So there's a number of examples like that where it's not new, it's just new in the sense that we have the ability to allocate to it.
So just out of curiosity with the audience, can I have a show of hands if you or your firm uses alternatives in the portfolio?
All right.
Yeah, a lot of hands. I mean, I would say half-ish is what I'm seeing. And what's interesting in my conversations, when I talk to other CIOs, when I go to other events like this, there is a similar degree of people actively using versus interested. And those who are actively using, I find in conversation, there's a lot of uncertainty about what it is they're doing. And so I'm hoping you can help them become more certain, feel more confident in some of these decisions, some of the things they can talk about with clients.
That's the fun part of it all. That's why I wrote the book. That's why I've kind of pivoted career-wise, is that I think a lot of advisors have kind of figured out how they want to allocate their stock and bond portfolios. Like they're not reinventing the wheel. I think they're becoming increasingly comfortable with alternatives, but there's not that same degree of confidence in implementation and evaluation. So I think that's part of what I enjoy doing, is just helping people figure that out.
Well, and I think the answer of no, we don't do it, just because you don't feel like you want to do the research, I think that you shouldn't be saying no to something that you don't understand. In general, and you and I've had this conversation before, more when you were a CIO than in your current role, but our job as an asset allocator is probably to say no more often than we say yes. And to me, I often equate it to like what the FDA does when they're approving drugs. The FDA wants to approve drugs, but they also want to avoid bad side effects. And so every single decision they make is a trade-off. It's a trade-off of type 1 and type 2 error where, if you don't approve something because of the side effects, you risk society benefiting from the importance of that drug. Meanwhile, if you approve everything that sort of shows to help society, you might have a lot of really bad side effects in there. Now, I will say, for the sake of conversation, I'm usually more concerned with implementing a bad idea than missing out on a good one. So I say no all the time. I would say that alternatives is one of those spaces where it has taken a very long time to hone my no. And I would even say today, my no is very conditional on the individual. I would say
You're almost at a maybe now, I think.
I'm still a no for more people than not. I think that they get overused. I think expectations is so important. And I don't think you need to be Yale or any endowment to succeed with alternatives. You just have to be humble with what it is and what it isn't, and just be realistic in general. I know that you have talked to a number of people kind of in that range. How do you feel when people say, no, it's just too complex to me? What do you do to sort of open the door to the conversation? And at least if they're gonna be a no, make it an educated no.
Well, first of all, I think there's a lot more interest and openness now post 2022. Whereas it used to be easy to say no because it was like, bonds they're doing what I want them to do. They're diversifying my stock portfolio. And then when that relationship changed, I think it was eye-opening. Okay, these relationships between asset classes that we maybe sort of take for granted and assume are going to exist in perpetuity aren't always there. And so I think it was, okay, maybe I do need sort of a third leg of the stool or a different set of exposures to help create a more diversified portfolio. It is challenging because you are introducing more complexity to the equation, and that can be challenging to sit in front of a household or a family and explain it to if they're not, financially, that savvy. I think there's ways to get around that and simplify the complexity for them and everything like that. I think, from an expectation standpoint, I think things that we're less familiar with tend to get a shorter leash when they don't do well. Whereas everyone kind of knows, like, stocks for the long run. I know I'm going to get some bad years, maybe a few bad years, but I think things that are just like unfamiliar and you don't, especially if it's like a really uncorrelated asset, like it can be really frustrating if it's sort of flat or down when stocks are up. And I think it's just really easy to throw in the towel when it's not something you've got that same connection to, like stocks or bonds. And so I think there's a little bit of performance chasing activity that can really take what could be a really great long-term addition to a portfolio, but if it's not used properly, then that's going to lead to bad outcomes. I think often there's like a tendency to try to, close the barn door after the horse is already out. If managed futures became popular after the financial crisis, they would have been great to own heading into it. And so that's, just behavioral, I guess, finance 101. And so, but I think from that, I think over time, like, lessons learned and people are more educated now. And I think there's more of a willingness to be more strategic about it as to thinking of all this as more of a trade. It's more of, hey, this is part of my core allocation.
Well, and I know all allocators love the idea of uncorrelated returns. They just don't like the actual experience of uncorrelated return streams. And I imagine anybody here in the audience who's been an advisor in the past decade has had to talk to clients about why they own international stocks. That alone is a great example of how the people that we are trying to help make good decisions with their money are going to need education, are going to need expectations set realistically. And that really starts with us. And let's get into some of that education. I think you had mentioned private equity when we were talking about the growth of private markets versus public markets. What do you think is important to know about the private equity space?
I mean, it's not homogenous. There's a lot of different parts of the private equity ecosystem. There's, what most people are familiar with, which is the buyout, space. But there's mega, buyouts. There's mid-sized, but kind of like, U.S. equities, like large, mid, small. There's large, mid, small buyouts. There's growth equity, which sort of sits between, buyout and venture. And then, of course, there's venture, which is, more early stage and riskier end of the spectrum. And so there's a lot of different, ways to approach private equity. There's a lot of different ways to invest in it too. There's primary commitments, so just investing in a fund, like as it's in its fundraising period, and that's typically like a 10 to 12 year, life. In a few years of your capital being called and invested, and then a harvest period, et cetera. That's a tougher dynamic for advisors, just given how illiquid it is, trying to explain J-curve dynamics to a client where it's like all this money is going out, but they're not seeing anything for a few years, so it requires a lot of patience. There's secondaries, which is growing rapidly And so I think that's part of why companies are able to stay private longer, is this kind of emerging and growing secondary ecosystem where you can purchase, sorry if that was not loud enough. You can purchase interest in a fund, later in its life cycle, like not necessarily, right when it's starting, but maybe it's an inflection point where it's fully invested. You know what the underlying portfolio companies are. There's less of a J curve. There's a shorter path to liquidity. So there's a lot to like about secondaries for investors in general, but specifically for RIAs, and I think secondaries as well for folks that prefer evergreen structures. Secondaries can play a big part in those. And then there's co-investing, which is sort of riding shotgun, if you will, next to a GP where they have a portfolio company that they want to invest in. Maybe there's $100 million of capacity. They've got budget for 70 in their fund, but can't go higher for purposes of concentration, what have you. And so they might, farm out the rest of that to some of their limited partners to invest directly in the company. And that's interesting because those tend to be, no fee, no carry, in a way to reduce the cost of owning private equity. So it's a very, complex ecosystem. There's a lot to learn and understand about it, but that's part of what we try to do at Cliffwater is package strategies in a way that the advisor doesn't have to make all those granular decisions around how to invest across the space.
Well, and I think that private equity, at least when I'm speaking to end clients and they say they want private investments, that's what comes to mind for them first. To me, though, the thing that I hear people talking about more in industry, at events like this, in the office, is private credit. In general, and maybe you can go through some examples, private credit can mean a lot of different things. But let's start with this. Maybe can you start by explaining why private credit has seen such explosive growth, sort of the bigger external factors that have led to it becoming a bigger place in the economy in the first place?
Yeah, I think a couple of things. One is private credit is not as new as people might imagine it is. I think because you're hearing so much about it today, it seems like it just sort of popped up overnight, like a few years ago. One of the things we pride ourselves on at Cliffwater is being really early to private debt. Cliffwater was founded in 2004. Our founder, Steve Nesbitt, he used to lead consulting at Wilshire Associates before founding Cliffwater. And, around like kind of the early 2010s, he started to really take notice of this growing asset class, who the managers were. And from Steve's view, it's like, okay, for there to be an asset class, there needs to be an index or a benchmark that people can reference for allocation decisions and risk management and just understanding the long-term history. So he set out to do that. And so our even though we manage funds and we have a consulting business, we also have an index business as well. We created what's become kind of the go-to benchmark for the direct lending space, which is called the CDLI, which is the Cliffwater Direct Lending Index, which basically what it does is goes through quarterly SEC filings from private and public BDCs and looks at all the underlying loans in those portfolios. And what that's been able to do, the index went live in 2015, back tested in 2004, but it basically gives a roughly 20-year history of how the asset class has performed, what yields have been, what credit losses have been. And so it's been a great way for a lot of allocators, both institutional and advisors, to get more comfortable with the asset class in general before they start making manager decisions in terms of products. And so we're proud of that index because I think it's really helped set a reference point for what it is. And ultimately, if you're not familiar with direct lending, it's lending to corporate America by and large. And corporate America is huge, and you have very big companies like Apple and Exxon that can tap the investment grade bond market. And then you have non-investment grade credit, which is historically been high yield bonds, also publicly traded, broadly syndicated bank loans. And then you have private debt now taking a lot of wallet share from those areas. And so what's happened is even the growth has been significant, but it's not without reason. And so really the vast majority of direct lending to what we define as like middle market companies, think like, 10 to $150 million of EBITDA. And this is a huge part of the American economy. I think a couple 100,000 companies that fall under that, definition. I think it's about a third of private sector GDP, like 6 trillion or something like that in revenue. So this is a huge part of the economy that needs financing. And not every middle market company is sponsored by a private equity company. I think it's about maybe 15% or so have private equity sponsors behind them. And that's pretty much the vast majority of direct lending is lending to companies backed by private equity sponsors. And so really, when you look at the trajectory of growth of direct lending, it's gone alongside the growth of private equity and that need for buyout financing, which historically used to be provided by banks. And post GFC, banks stepped away from doing a lot of that lending. And so it's been largely, partly regulation driven. I think also private equity sponsors just prefer to work with private, lenders because of that speed and certainty of execution that we can offer them. And that's why there's a yield premium there. They're willing to pay that yield premium in exchange for that reduction of uncertainty.
Well, and the institutional adoption of this space has been really high because, one, you're earning a higher yield. There's a lot of demand. It's easy for the dollars to find loans, or at least it has been the past decade. As you mentioned, the banks sort of stepped out of this area of the market post-financial crisis. But also, historically at least, the covenants have been more beneficial to the lender than you might have gotten in high yield or junk bond issuance. And so that's been really attractive to a lot of institutional investors. Now, there was actually something in The Economist, I think 2 weeks ago, kind of pointing out that at some point, too many dollars chasing it can weaken covenants. But that really means that not all private credit providers are created equal. You have to make sure that the manager is maintaining some of those really strict preferential covenants that make these, even though you're going to earn the illiquidity premium, that you're a little more protected than you would be in a traditional high yield junk bonds. Any thoughts on that?
Yeah, I mean, it's credit. It's not this is not a free lunch. Those yields are not, for not taking risks. So for us, it's, your upside in the asset class is your yield, and credit losses and expenses and fees are what give you your net return. So that's how we think about building a portfolio. And back to my comment earlier about, the benefit of Cliffwater being really early to private debt is that our research team got to know all the players really early. And there's over 300 direct lenders today. We know all of them. And we probably think about 50 of them are what we would call A-rated lenders. And when we build products like our interval funds, the idea is to not just, we don't originate loans at Cliffwater. We work with, investment partners. We have about 20 institutional quality lenders that we work with that we think are, top tier, top quality, that we think, again, can help mitigate losses and when credit cycles emerge. And so that is a big part of it, is that not all lenders are created equal. And I think a rising tide can at times lift all boats, but then, when the tide goes out, as Mr. Buffett would say, well, everybody knows the quote, but so that's one aspect. And I think it's an asset class that you want to be very diversified in, because not so much for, quote unquote alpha, it is more of a beta asset class. There's not as much dispersion between manager returns as you'll find in venture capital or private equity. But in our view, I always like to say, if you have a big blow up in credit, at the scene of the crime, you're going to find leverage and concentration. And so that's really what we try to do in our products, is how do we, use modest leverage, but not extreme, and not have any one single position able to blow us up.
And that's what's funny is when risk and return are so closely linked, this is the one place where you don't want risk. Risk management seems to be so much of what returns are.
And I think that's one of the benefits of the interval fund structure is there's regulatory limits on how much leverage you can use. It's a half a turn of leverage. If you look at private BDCs, which is another way that a lot of advisors access private credit, they can go up to 2 turns leverage. Most don't go that far. They usually, 1 turn, a little bit higher. But when you look at how we invest, I think in our main fund, CCLFX, our top 10 holdings are about 5% of our portfolio. If you look at the average of the top 25 BDCs, they have typically around 40% of their portfolio in their top 10 holdings. And so for us to work with 20 different lending partners, it allows us to create, a portfolio that is not an index fund, but in many ways mirrors the spirit of an index fund, which is just broad diversification, over 3,000 credits, that sort of approach.
Now, for everyone in the audience, and then for those listening on the podcast or watching on YouTube later, or this will be replaying on Cheddar's media channel in a few weeks, I think, you go to a lot of panels and you assume they're sponsored, and you hear Phil talking about Cliffwater. And this is my podcast. I just invited Phil because the book was so well written. He outlines this well. This is not a commercial, in my opinion. And one of the things, because I know your publisher is out there.
And I wrote it before I was at Cliffwater.
That's right.
It's not a commercial for my current employer.
I appreciate the perspective as a practitioner, and we're going to get into that in a second. But there's a number of graphics in the book and I'm going to talk to your publisher right after this, as well as you. See if we can put
I see him standing there. He's a very tall
Hey,
gentleman.
Craig, how are you? You guys, Harriman House is in the house.
Yeah.
We got to get some of these images up at the show notes at thelongterminvestor.com, because I think it helps really distill down some of these key concepts. And you look at something like private credit, and then you see some of the niche credit areas like royalties, like litigation financing, like aircraft financing. You say, gosh, there's so much stuff out there that maybe you didn't know about. But since I'm going to do that at the show notes at thelongterminvestor.com, I want to kind of jump into something you said about interval funds. And also, Morningstar didn't ask me to do this, but like 2 days ago, they put out a 20-page report on interval funds. I will link to it in the show notes. There's a couple bullet points that I wrote down from the report that I think can kind of set the stage for just how important interval funds have become to the alternatives ecosystem. So looking at the past 10 years, so just 10 years ago, Morningstar tracked 14 interval funds with about $2.9 billion in assets. As of June 2024, Morningstar tracks 100 interval funds with over $80 billion in assets. So that's an annualized growth rate of 39%. For what it's worth, Cliffwater Corporate Lending, the report notes, is the biggest interval fund with $19 billion in assets, and it only launched in June 2019. So that's kind of a good example of how fast that area is growing. It's also a good example of what they point out in the report of how skewed the overall market is, where the top 5 funds oversee about 60% of the AUM in the interval fund space. And as of 2024, about 2/3 of interval funds were owning taxable bonds, real estate, or municipal bonds. Great report. Again, I will link to it in the show notes at thelongterminvestor.com. I want to focus not just on interval funds, we'll talk about tender funds, but before we do, you talked about the J curve earlier, and I held off asking a follow-up until now. Talk about the normal path with which somebody is going to finance a private investment in a typical drawdown function, and then maybe transition into how the interval fund opens up that structure to more different people.
So like for private equity specifically, I think for a while, kind of like a theory versus practice. I think there a lot of advisors were like, in theory, sounds great. Would love to have some private equity in my clients' portfolios. In practice, like I don't want that because the administrative and operational burden that would introduce is not something they wanted to entertain. And that was because up until the emergence of things like interval funds or tender offer funds or what have you, the classic way of investing in private equity is through a limited partnership. And that would have a number of features, and many of which most advisors would find annoying, especially if you're trying to operate at scale and have model portfolios and consistency across client accounts. And maybe your client base is not all qualified purchasers. So there's a lot of things that kept limited partnership investing in private equity sort of, a bit at arm's length for advisors, because they didn't want the stated minimums for the funds to go direct were too high. They didn't want to deal with K1s for either they or their clients didn't want to deal with K1s for tax reporting. The J curve that Peter mentioned, like that's the dynamic of just, committing $1 million to a fund, but it gets drawn over 3-4 years and you're not seeing results. So it's really, and you're paying fees on that committed capital too. And so there's an extra, the advisor then has to figure out, well, how am I going to, all this money I've committed, how am I going to invest that? Am I going to park it in T-bills? Am I going to put it in bonds or public stocks? So it's like all these like other decisions that get introduced as part of the equation. And then not to mention the idea of like building a diversified private equity portfolio is tough. Like, it's not just like, hey, I'm going to pick one fund in one vintage year from one GP, because that's not how you build a self-reinforcing program. Like, you want to have vintage diversification and manager diversification, strategy diversification. And if you're doing that from a kind of, bottom-up standpoint, unless you've got, $100 million or more, that's a really challenging thing to do. And I would even say, even if you do have that kind of wallet, you might not want to do that because it's just very annoying and inconvenient. And so I think really what interval funds attempt to do is, make the access easier, but also like take, absorb some of those decisions that the advisor would otherwise have to do in terms of, not having capital calls, stepping in immediately into a diversified portfolio, lower minimums, ease of transacting. So no subscription document you got to fill out. Their interval funds are all ticker symbol traded, and 1099 for tax reporting. And so there's just a lot of these, features, both from an operational standpoint that are attractive, but also when you think of just like, long-term compounding of capital, like people see the IRRs on drawdown limited partnership funds, and maybe they say, oh, we're targeting 20% net or something like that. I wrote a whole paper on this, which is when you're investing in evergreen funds, it's time-weighted returns are what matter. That's what's measured. In a drawdown fund, you're looking at IRRs. Those are not apples comparisons you can make with those metrics. And if you actually consider what someone might be doing with their committed but not yet called capital in a drawdown fund, it actually takes the stated IRR down significantly, sometimes cutting it potentially in half if you assume that someone's using T-bills or fixed income for that committed capital. And so you can get to the same multiple of capital potentially with a low to mid-teens return in an evergreen fund and get relative to a drawdown fund with a 20+% IRR, just given that dynamic of not sitting on a bunch of unfunded commitments and being fully invested from day one. And I think it's just nice to have more control over when you enter, when you exit, being able to do it across all your client accounts, easily in a timely fashion versus sort of the more kind of hand-to-hand combat of like, hey, each client's got to fill a subdoc out and all this other stuff. So I think it's really helping bridge that gap and allowing advisors to make these a core part of their practice and not just a one-off for their biggest clients.
Well, and for the end clients, it also makes their life simpler too. I mean, I can't tell you, we have a number of clients in private traditional drawdown funds where their tax returns delayed simply because of their investment. And there isn't a lot of material evidence that would suggest a drawdown fund is better than an interval fund. I don't know that I've seen anything that's conclusive. Now, I haven't seen anything that's conclusive that an interval is better than a drawdown, but my point being, I think what you will hear in the marketplace from some advisors who outsource their private research to somebody else is, hey, we're doing the real thing by investing in drawdown funds. Using an interval fund, that's not the same thing.
Yeah,
there really isn't
there's
any
more sex appeal to the drawdown funds, but we're not selling sex appeal for our process. We're trying to build elegant solutions for advisors to use to get comprehensive exposure to private equity, private debt, et cetera. So,
I want you to put your CIO hat back on for a bit. You have a room of investment decision makers. If we're building out an alternative sleeve that's going to incorporate private credit, private equity, maybe, and if you want to throw in hedge fund strategies or real assets, so be it. What are some of the things that you are going to think about with allocation decisions to those different buckets?
First and foremost, like objective. What's the client trying to achieve? Are they looking for longer term, appreciation? Are they looking for income, inflation protection, just general, low correlated assets? Like that's kind of step one. I think beyond that, like it's what's the budget for liquidity? What's the size of the households? There's a lot of variables. Like what's the tax status of their various account types? Because that can, obviously we want to look at expected returns from an after-tax standpoint. And sometimes you can get around that if clients having, a balanced mix of IRA and Roth and taxable accounts. In some cases, when it's almost all taxable money, that can change the dynamics a little bit. So there's like too many variables to list. But I think from a just like starting point, like blank slate, like I think you want to have some exposure, to private equity and private debt as sort of core asset classes where you have an expected illiquidity premium to their public market equivalents. But don't assume that those are going to be these truly uncorrelated types of alternatives. And if that's what you're seeking, that's not, those are more return enhancers, I would say, relative to true diversifiers. If you're seeking out true diversifiers, like things like catastrophe reinsurance and managed futures are asset classes and strategies that have tended to demonstrate that benefit. And then, of course, there's things like real estate infrastructure that are becoming more popular that have, kind of blended benefits of income generation, inflation, protection potential. So, a lot of different ways to slice and dice it. I think, in terms of size, single digit allocations aren't going to move the needle. So I think it's like there's no right answer. It just, my view has always been it's got to be enough to matter, but not too much that it dominates the conversation at every client review meeting and introduces behavioral risk. And then, sourcing is another consideration, like where are you taking it from? In some cases it's easy. Your private equity should come from your public equity. Other cases, maybe it's a bit more nuanced, things like private credit. Maybe, maybe it comes mostly from your bond allocation. If you have a standalone high yield bond allocation, maybe it start there, but it's not going to be a great substitute for treasuries. either. So I think being thoughtful of not just bucketing things because they sound like they should fit in certain areas, but really understanding the downside risk and correlation between asset classes and kind of sourcing, based off of that.
Well, and I will share how I think, and I would love for you to critique or praise. But as I mentioned earlier,
critique, but
that's fair. So, as I mentioned, when the time when the book came out, the way that we approached alternatives and privates was relatively reactive, and it was from a mindset that I would say overweighted minimizing mistakes and met some of the, as friend of the show, Mayor Statman would say, met more of the investor wants than the needs. And now today, the way that we think about it, and I think part of the objection I've had is I don't know that people who are doing model allocations for alternatives that are the same across all of their clients based on their, if they're normally a 70-30, you have a model sleeve of allocation to alternatives. To me, that doesn't make sense. I think it's a very individual process. There's a couple different drivers, like you said, objective, liquidity needs. I would argue that basically anyone who's serving a high net worth client, that client is probably overweight liquidity anyways. And so but how much overweight liquidity are they? Risk tolerance, time horizon, all these things come into play where if I have someone who's originally a 70-30 portfolio or a 60-40, we'll go more traditional, it might mean I'm adding 10% alternatives. It might mean I'm adding 15. I don't think in any realm that people need to pretend like they're an endowment. Even if you're a $100 million family, a $500 million family, an endowment is just different. And you talk to people running endowments and they will tell you, you should not be running your portfolio like an endowment. But also the makeup of that sleeve, I personally feel should differ from investor to investor. I realize that's operationally a headache, but how do you think about that?
I don't think it needs to be necessarily customized by each investor. I think for the ones that are truly I think you have a common core, if you will, that you have across accounts of just broad asset class exposures that you think every client will benefit from to some degree. And then maybe for, maybe it's larger relationships or those that are just more engaged in that world, or maybe have a very strong thematic view on something. Maybe it's a subset of venture where they're just really excited about cybersecurity or something, and they want to make a direct commitment to a fund that invests in those types of startup companies. So I think it can get a little bit personal, but maybe you do it a little bit judiciously and not for everybody. But for the less interested investors, which is probably most clients of most firms, that's why they hire us. This is not it's not interesting to them the way it's interesting to us. And that's where you get a little bit more consistency and commonality across accounts. And then maybe you have a broader menu behind that of, a little bit more targeted exposures or things that have a little bit more of that, appeal to them that might have a smaller audience that you can, use for that.
And keeping your CIO hat on, I'm going to borrow a phrase that you once said on my show, I don't know how many years ago, but being CIO is just as much about picking investments as it is curating the experience of investing. And so I think a lot of our role these days is not just due diligence, it's communication. And if you're an advisor rolling out an alternatives allocation, or if you're an end client about to receive the rollout of an alternatives allocation, what are some of the education points that you think need to be put forth right away to both set expectations appropriately and give people a good enough understanding that they can tell time, but maybe they don't know how the watch works? Not everybody needs to know how the watch works. You definitely want your clients to be able to tell time though, because otherwise, when the strategy appears to not be working, which means basically it's underperforming the S&P 500 or the bond market, it may not be that it's not working, it's doing as expected. So what are some of those education points that you think people should focus in on when introducing these ideas or being the receiver of these new ideas?
I think, particularly for certain categories where most of the time they don't move around a lot, and so it can create this false perception of really, really high returns and no volatility or risk, and you don't want to extrapolate that. So I think it's helpful to level set and say, look, just volatility is not a pure proxy for risk, and then help them understand what is the actual downside risk. And in the case of private debt, for example, our corporate lending funds we just had our 5-year anniversary a couple of weeks ago, but that's not an incredibly long time period. So we would, urge our advisors that use our funds to then use our index. Our index goes back about 20 years and covers some really interesting periods there. And you can actually see how the asset class behaved in those. And so I think that can help use the longest data set that you have. And in some cases, you might have to lean on, some sort of back test or index as opposed to a live fund, because a lot of these products are on the relatively, newer side. So I think that's one. I think for the advisor evaluating products, like for something like credit, like really understanding like the concentration of the portfolio or diversification of it, how much leverage is being taken on, because that can, get dismissed easily when things are going well, but it can lead to some bad outcomes when things aren't going so well. So I think just understanding some of those dynamics. And what else was in your question?
I mean, it was pretty open-ended education, but let me throw some kind of related topic, which would be benchmarking. So as you're looking at performance reports with alternative allocations within them, what benchmarks do you feel are appropriate? And you can go as narrow by category or as broad holistically as you'd like.
There's, benchmarking like private equity, for example, is kind of tough. Like, especially if it's like our fund is daily NAV. A lot of other evergreen products are monthly NAV, but then a lot of the private equity benchmarks are quarterly with a lag. And so it's harder to judge like real-time performance. I think other ways advisors approach it is if they expect a certain, return premium relative to public markets, and they sort of use that index and maybe not year by year, month by month, or just over a long enough period of time. Is this private equity solution delivering the expected outperformance invested in it for relative to like the MSCI World or Russell 3000 or whatever the case may be? And so, and I think we've, obviously I'm promoting, but I think we have kind of like, if you look at any private debt pitch book from one of our peers or competitors, like they're using our index because it's like kind of the only game in town.
Now, is your index available on like Orion or Tamarack or any of those?
It is not. And it is quarterly too, because it's going through quarterly SEC filings of BDCs. So again, this is not like a real-time index that you get an updated daily mark for. So it is challenging, I think, often for purposes like, performance reporting solutions for clients. Like usually what I, in my, prior experience and what you see typically is some kind of public market proxy. Because if it's a daily NAV or even monthly NAV vehicle, that's probably your best bet, is you got to find some sort of public proxy index to use. So it's not a perfect solution, but.
Well, and it all goes back to objective. So when I think of our reports at PlanCorp, we benchmark. We just have on a page all of our U.S. holdings benchmarked to the Russell 3000, all of our non-U.S. equities, so developed and emerging, benchmarked to MSCI ACWI US net, not gross, of course. Fixed income's the ag, but with alternatives, we have inflation and T-bills. A lot of people will show cash, and for inflation, and I'm not saying this is right, I'm just kind of sharing, I'll get your own reaction. In general, the reason we invest, first principle, why do we invest? We invest to outpace inflation without taking undue risk. And so I think, granted, the objectives and the makeup of an alternative sleeve can be different from client to client, in my world at least. Inflation should be beaten at some point, unless you're just in diversifying strategies, I guess. It never really occurred to me until this very moment that if all we were doing were diversifying hedge fund strategies, probably not the best benchmark. You're probably looking more at cash. What are your thoughts?
Or cash plus or something like that. I know we're getting short on time, because one thing I'd also like to add for interval funds, that's what we operate at Cliffwater. They look a lot like mutual funds. And I think that's one thing just to be very, I would over communicate to end clients the liquidity component of interval funds, because I think it gets too easy for them to confuse it with a mutual fund. And the last thing you want to do is have a mismatch in expectations on liquidity. And so it's not just that it's offering quarterly or semi-annual or whatever the frequency of repurchases. And those have to be a minimum of 5% each period. If there's a large amount of redemptions in a given quarter, then an interval fund can be prorated. And so an investor might not get 100 cents on the dollar back in a given time. And I just think that's something you want to be very clear about up front with clients that are new to this structure, because it can get easy to gloss over, because it does kind of look and smell and feel like a mutual fund. So it's just something that, from learned experience and from my prior days, measure twice, cut once there is what I would advise.
Yeah, certainly in the news several times. The gates are not a bug. They're a feature. They were what allow the illiquid assets. We're out of time. I appreciate everybody joining us. Again, Phil, thanks so much for being on the show. You'll find detailed show notes at thelongterminvestor.com. You'll see this replayed at YouTube at Peter Lazaroff. Thanks again.
Thanks, everybody.